Welcome to the Leaders Insights podcast. Today's episode, ESG reporting is now a CFO problem, not a comms problem. If your sustainability report still lives in the communications department, you're already in regulatory trouble. Here to break down why ESG has become a core CFO discipline is someone who's lived through this transition firsthand. Welcome.
Good to be here. And yes, the comms team can write the narrative, but they cannot sign off on material climate risk disclosures to regulators. That's a CFO signature now.
Let's ground this immediately. What's actually changed in 2026 that makes this a financial obligation rather than a reputational exercise?
The EU's Corporate Sustainability Reporting Directive is now in full enforcement for large listed companies, and the SEC's climate disclosure rules survived the legal challenges and are binding. These aren't voluntary frameworks anymore. If your Scope 1 and Scope 2 emissions data is wrong, you have a material misstatement problem, not a PR problem.
What does a material misstatement in ESG data actually look like in practice?
Look at what happened to a major European industrials group earlier this year. Auditors flagged inconsistencies between their reported Scope 3 emissions and the underlying supplier data. The restatement triggered a debt covenant review because their sustainability-linked loan had emissions reduction targets baked into the pricing. The interest rate stepped up by 40 basis points overnight. That's a cash flow event, not a headline event.
So sustainability-linked financing is now a direct P&L exposure.
Exactly. According to Bloomberg data, and they flag this as market intelligence rather than audited figures, somewhere north of $900 billion in sustainability-linked bonds and loans are outstanding globally right now. Each one has performance triggers. CFOs who don't own those metrics operationally are flying blind on their own debt obligations.
How are the better prepared CFOs actually organizing this internally?
The ones ahead of this have embedded ESG data governance into their existing financial controls architecture. Schneider Electric is a good example. They treat carbon accounting with the same internal control standards as revenue recognition. That means reconciliation processes, audit trails, variance analysis. Not a PDF that someone compiled in PowerPoint the week before publication.
What about smaller companies that don't have Schneider's infrastructure?
The regulatory thresholds do create some breathing room, but supply chain pressure removes it. If you're a mid-sized manufacturer supplying to any major European or North American corporation, your customers are now collecting your emissions data for their own Scope 3 reporting. Customers like Unilever and Apple are contractually requiring it. So the question isn't whether you'll report, it's whether your numbers will hold up to scrutiny when they feed into someone else's audited disclosure.
One concrete action for a CFO listening right now who knows they're behind.
Run a gap analysis between your current data collection processes and what an external auditor would actually require to provide limited assurance on your emissions figures. Most CFOs are shocked by how many manual spreadsheets are sitting in that chain. Find them before your auditor does.
Clear and direct. Thank you for the time. To go further, Leaders Insights offers strategic training programs, diagnostic tools, and an executive self-assessment designed for CMOs, CDOs, CFOs, and leaders aiming for board-level performance. Explore everything at mba-training.com. Thank you for listening to the Leaders Insights podcast. See you tomorrow for another episode.